Good afternoon, and thank you for joining us today. And my name is David Talbot. I'm Managing Director and Head of Research at Red Cloud Securities, and I'm delighted to host a Red Cloud webinar on uranium today. We are going to hear from GoviEx CEO Daniel Major. Now, during today's webinar, he will provide an overview and outlook. Then we will take your questions. You can type your questions into the chat box at any time, and we will get to as many as we can. But before we kick things off, first we need to discuss the fine print. During today's GoviEx webinar, forward-looking statements may be made. I direct listeners to the forward-looking statements outlined on page 2 of the corporate presentation, and that can be found on the company's website, goviex.com. For Red Cloud Securities, I'd highlight this webinar is for information purposes only. It should not be considered a solicitation or recommendation to buy or sell securities. We note this call does not consider the situation or particular needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. So please see our most recent research located on the Red Cloud website for specific disclosures on GoviEx Uranium. Now with that, I turn it over to Daniel to update the audience on GoviEx.
David, thank you very much, and thank you for the introduction there, and appreciate being invited on for one of Red Cloud's very excellent webinars. We're going to take ourselves through GoviEx. We are very much focused on advancing our Muntanga project, very much strategically positioned in Zambia, a great country and certainly within great geology in relation to uranium. As David pointed out, there may be some forward-looking statements. Our disclaimers and cautionary statements are here, and we'd ask you to read them. They are available on the website. But to move forward, we are a focused, growing African uranium company. Our primary focus is in Zambia. We have 4 mining permits there, 4 mining licenses and 2 exploration licenses. We still very much believe in the fundamentals of this uranium sector. We are expecting uranium prices to continue to go higher, and certainly more and more of the news is focused on the development of the nuclear industry and its various aspects around the world. Within GoviEx, we not only have our Muntanga project, but some considerable exploration upside within the Karoo sands that are within Zambia. And on that Muntanga project, we own 100% of it. We have completed the feasibility study in January and represented a project with a post-tax net present value of $243 million with an OPEX at $32 a pound. So very much on track to become a producer, subject to the market as well. So just to highlight that project that we put out, a strong net present value, NPV at 243, IRR at just under 21%. That was at $90 uranium. At $32 cash cost, putting us well within the third tier there. A quick payback as well at 3.5 years. Initial capex coming in at just over $280 million. And the project remains highly leveraged to the uranium price. So for every $5 move in the price, adding $45 million to the net present value. And it has 12 years of mine life, and that's only based on the 2 core projects of Muntanga and Dibwe East. And we have upside beyond that with the satellite deposits. And as I'll explain later in the project, we're now targeting other areas to see how we can increase the life of mine and or increase the production rate of the Muntanga project. It is low risk. This is a very shallow open pit mine. We go no deeper than about 120 meters. The Muntanga deposit actually only goes down to 50 meters in depth. And accesses ore very quickly and is able to start feeding the processing plant once we go to commissioning on there within 4 months. It's conventional processing. There's nothing new. We follow a straightforward heap leach, ion exchange, all the way through to standard production on uranium. Excellent infrastructure. Being in southern Zambia, we are right next to metalled roads. We're next to the Kariba Dam, with power. The government in Zambia is doing a considerable amount of work as well, focus on expanding power, putting on new coal-fired power stations, adding considerable solar to the grid as well, and interconnectors through to other regions, with a design to go out to bigger capacity on production in copper, etc. They've realized that the overall infrastructure of the country has to improve, and we look to benefit that. We're right next to a well-established export route, potentially serving both east and western markets. And that would take us out to Walvis Bay, which of course is where all the Namibian production exits. And in fact, Kyla Carrier Lotus would also go past our front door to go through Livingston out to Walvis Bay. The rock is soft. That benefits us from a low powder factor, so helps bring our mining costs down. But also we only need to crush it quite coarse to 25 mil an inch. So not high power consuming. It's only 7 megawatts for the whole operation, processing 3.5 million tons of rock a year, with very excellent mineralogy and low acid consumption. We're looking at about 90% recovery, or at least 90% recovery, and low acid consumption, very little calcium in it. But in a country that produces sulfuric acid, and with the expansion on various smelters within the country, increasing the amount of sulfuric acid, and more importantly, the massive expansion being done by Ivanhoe at the Kamoa project will bring in about 400,000 tons of sulfuric acid into the market there, and we only use about 17,000 tons. So a lot of access to sulfuric acid, which is a primary consumable. In the case of Zambia, very much a low risk entity. It's been democratic since 1964, one of the longest democratic governments. It is very pro-mining, very much focused on copper at the moment. It is actually the 7th largest copper producer in the world, the largest copper producer in Africa, and is targeting this tripling up of copper production and looking at diversifying into other commodities. It's doing a massive geophysical survey at the moment across the whole country to try and target areas that have not been seen before with that level of geophysics, and trying to incentivize others to come in. And it's found a pretty good balance between the USA and China. China has historically been there for a long time, investing in a large railway line that goes all the way out to Tanzania, and is a number of the copper projects there. But is also finding good engagement with the US, with the things like the Loboto corridor going out to Angola, and a lot of focus from the DFC, etc. And for us, that access out to a recognized uranium export route is very important to be able to ship out. And it's well understood, and it's a well-developed metalled road all of the way. So just to remind you, we're sitting about 200 kilometers south of Lusaka, the capital city. It's about a 3.5-hour drive. Good infrastructure with the Kariba Dam very close by. We've got excellent water in the vicinity. We have more than enough water from groundwater. Don't have to go anywhere near the Kariba Dam. But it's got this 3 main permits sitting there, Dibwe, Muntanga, and Chirundu joint venture, which provide the potential to develop this mine, and mainly around Muntanga and Dibwe East. But we've got a lot of prospectivity here, and we'll come to that just now. So we're looking at a capex at about $282 million. We have sustaining capital following on, mainly for mining as the mine ramps up. But the initial capital is heavily weighted towards the processing side. OPEX, pretty evenly split between the mining and the processing costs. That does not include the 5% royalty as well that we would have to pay on revenue coming through. As I said, a net present value at $243 million at $90 uranium, with the other sensitivities provided there, with every $5 giving an extra $45 million to net present value. We've been moving forward since we put out the feasibility study We have subsequently filed the ESIA with Zambia's Environmental Management Authority. They're currently reviewing that, and we've been doing a number of stakeholder programs. We have recently, this week, completed the documentation for the relocation action plan. So we have signed off with every community member exactly what they will receive in compensation to allow us to move them off Muntanga and Dibwe East to the new centers where we've agreed to place them, which are nearby, so they can continue to access work and employment and benefit from the development of the Muntanga project. We do continue to engage with off-takers, particularly the North American, the European ones, and we have worked well with Endeavour. We have got a number of LOIs in. However, there are commitments there to get higher prices or underpin the financing with pricing structures. And as we continue to see a much better uranium price, but stuck in the 70s on the spot market, obviously this is going to require a higher price to be able to make all of the commitments we need for the development. We use $90 for the project. It works well still at 80, but at $70, we're taking an opportunity now to really look at what we can do to make this a better project as well. We also have to wait for the ESIA and the RAP to be approved as well, and that can take up to 6 to 9 months. So we're going through that process. We are looking at, on our mining side, can we look at a larger fleet? Can we get better capacity through here? Will it reduce our costs? So if we can get bigger capacity through here, obviously that would help bring down our unit cost, both on unit cost of CapEx and unit cost of OpEx. On our process design, we appointed a project and commissioning engineer, a Zambian gentleman who's got a lot of experience, particularly at Kyla Carrier and Langer Heinrich. And his task at the moment is to go through the feasibility study and look at options for us of what we can do to, one, reduce the costs, debottleneck. And again, can we look to higher output from this project? Can we reduce our unit costs and therefore improve the feasibility study? While we look at a uranium price around the mid-70s to low 70s in spot, take this opportunity while we're waiting for the ESIA. As I said, there's a lot of exploration here. We focused on getting Muntanga and Dibwe East up and going. We have the satellite deposits as well. But if we can add more pounds, then we can improve the economies of scale on this project and make it an even better project as we go forward. So that's really what we're doing at the moment this year, while we continue to work on the debt financing discussions. We're looking at the project itself, and we're moving forward on the ESIA. And once we have that ESIA in place, that will be the last permit we need. Subject to financing, we can start construction on the project. So really, we're looking at 4 main areas, really split into 2 parts. One, those that are very close to the mine, which if we can add pounds, can be added directly into the Muntanga project. But more importantly, the greater, larger area that we have and looking for potential. And so, can we add pounds? The first one of those is Muntanga East. I'll just remind you where that one is. So that's Muntanga East, which is right next to the Muntanga. It's 4 kilometers away. We're looking at the Dibwe deposit as well. We got Dibwe south over here, which is an interesting anomaly, never checked. And the more interesting one is Kariba Valley for scale. So at Muntanga East, we're looking at something that's very shallow. It's very close. It's the same mineralogy as Muntanga on the escarpment. And we've got a number of drill holes in there as well. We have already been drilling there, and certainly, we're yet to be disappointed. But we'll wait and see what we've pulled the whole number together. But certainly up front, the geologists were looking at something between 2 and 4 million pounds, between 150 and 350 ppm. So that if we can get those kind of volumes, those can be brought right in on top, either at the end of the life of the current mine or bring it in earlier, get the mine to a higher rate of production to go forward. And you can see the contour of the surface there. It is very shallow. It's less than 50 meters to the bottom of that and very continuous going through. Over at Dibwe, we have an anomaly. Most of the drilling has tended to go in a different direction up towards the northeast. That anomaly still to be drilled indicates that there's radon there. That's exactly what it is. It's a radon anomaly, and we have to go and test that to see if there was a reason why it was not done, and can we expand that resource. But this is the one that really interests us. This is on Kariba Valley. It was a project that was owned by Africa Energy before we acquired it. And you can see here, this is an area, it's about 3% of the total license area, where they had drilled a series of lines, which were very constructive, given the amount of red and orange in there. From a mineralization point of view, this covers about 4 kilometers and about 1 kilometer wide. And mineralization on the holes that they drilled went down to at least 110 meters. But you can see there's a very clear gap between them where they actually never drilled any holes. The reason for that is it's quite rough terrain in here. But certainly just looking at this, we certainly think we could be sitting at 20 to 30 million pounds here. So another Dibwe East is more than possible here. So just looking at it in section, it just highlights what we're seeing here. So we have a series of holes drilled out in a line. You can see there's a very clear gap between them. We've already sent the bulldozer in there to clear the path for that all the way along this 4.5 kilometers. But not only did they not drill the gap, they finished off the drill holes in mineralization for some reason and never carried on drilling. And they never closed off the mineralization to the north and south as well, or the east and west. So in fact, this prospect remains open. As I said earlier, it's only 3% of the total license area as well. So Kariba Valley is a whole new exploration target for us, but we already have some drill holes in it to give us guidance of where to. We already have a substantive resource. We've got 44 million pounds. And as I said, most of it's focused on the feasibility study only on Muntanga and Dibwe East. There are further opportunities to add through the inferred resources by additional drilling into Muntanga and Dibwe East or Dibwe to bring in more pounds. So again, very much focused on where we can go. We remain very much committed to our communities. We've done a lot of work with them. We have done a lot of work to prepare workers so that we can employ them in the future, and are about to start an education program looking at carpentry and brick building. Why those two? Because we have to build a new village for the community. And so we felt, why not train the villagers themselves to be part of that construction? And then as they move that, we can then start to train them for works on the mine. We maintain a strong focus. We report against a number of standards already, and that has helped us in the preparation of our ESIA, and certainly helped in handling the relocation discussions as we're very much tying everything back to the IFC and making sure we're following international standards. From a uranium market point of view, everything is improving as far as I can see. Every time I read something, it's all about new build. And I think certainly reading things like the WNA, UX Trade Tech, all of these trade magazines, the amount of new builds and developments coming through and areas that you've not seen them in the past. And even here in the UK, commitment to build and a commitment to SMRs is coming through. So you've got the US clearly with their strong bent towards nuclear growth going forward. China continues to commit to more development. India as well. So you've got fairly substantial growth scenarios here, and that's flowing through into Europe. That AI strategy continues to talk as well, with Talon and Amazon agreeing to have 1.9 gigawatts per annum just for AI, and Constellation and Meta a similar contract. So, AI remains a big driver for our industry, probably be very supportive for the SMR part of it as well. And we continue to see a lot of interest in the SMR market. But also, I think the more exciting part of this for me is we've started to see a real change in investor sentiment towards nuclear. And we'll start with the World Bank, who's changed their stance on it in June. and now are willing to make investment into nuclear projects for the first time. And that will flow through to things like the AFC, the IFC, etc., which will allow developing nations to start investing in nuclear energy. But you've also seen investment in large scale getting into reactors as well. So Apollo Global going into Hinkley Point, and Terra getting substantial amount of money from Nvidia and Bill Gates. So there's real money now coming out of the investment community to drive nuclear forward. And as that drive goes forward, obviously there's more need for uranium. But I think the other side of this, we know there's a long-term demand gap out there. But I think what we've seen this year is the prices have remained fairly flat around the $70 level. And certainly the feedback from the NEI conference earlier this month is that really uncertainty continues to be the problem with tariffs, political uncertainty. And as a result, utilities have tended to avoid making decisions and have been putting those decisions off. And so we are seeing contracts getting shorter, people making short-term decisions, but nobody committing to the long-term decisions. And that has been squeezing it. So I think as we start to see improvement in that understanding, or utilities get to the point they can no longer defer the problem, we will see a lot of increase in focus on purchasing into the market, both in the spot and, more importantly, into the term contract. And that should drive the price. This time of the year, it's usually very quiet anyway, and certainly it tends to pick up after August into September, with the W&A conference in London being a primary driver for that pickup. So it's what we're looking for. If you look at the company, we certainly are, looking undervalued. We think we should be moving up on those levels as well, particularly when we look at where we are from a development point of view. Look at where we are. We've raised $10 million earlier this year in May, very nicely supported out of Zambia itself, Manel coming in. So we're well cashed up for well over a year on those funds. The board remains unchanged, but also has considerable skill in Africa and in development. So really, we've got really good prices out there. But they need to get higher for our industry. You've seen that with a lot of the development peers who are holding back still. I think those prices will come higher. We've still got incredible growth development as well on the reactor side coming through. We've got a very robust project. We presented out and worked well already on the debt side. But certainly with the uranium price being where it is, while we wait for the ESIA, we think there's opportunities to certainly relook at the potential for our geology. Can we make this project bigger? Can we improve this project as well while we wait for the various aspects that are needed to fulfill the development of the project? So thank you very much. Appreciate that.
Great. Thank you very much, Daniel. Great presentation as always. So we will now kick off the Q&A portion of the webinar. Reminder to anyone that you can type your questions into the chat box, and we will get to as many as we can. So we already have some questions here, Daniel. Now, you've had multiple African projects in the past in various countries. They were perhaps earlier stage at the time, but would you consider getting back to focusing on multiple projects?
I think at the moment we're very happy in Zambia. I think we see Zambia has a lot of potential. I mean, obviously there are other projects in other areas, but I think at the moment we are the only uranium explorer in Zambia. I think what we're already seeing from our own exploration and really going back to look at Kariba Valley, there's a lot of potential. We have started to use some AI tools as well to really understand. For a company, we've been so focused on resource drilling, infill drilling, and we've really not looked at the exploration potential. But now that's really changed, and we're starting to get a grip of where the optionality is here in Zambia. So I think at the moment, yes, we'll add projects, but we'll be looking to add themselves. We're already pegging for licenses in Zambia to increase our foothold there.
Okay, we might come back to that in a little bit. Already strong NPV and IRR, as you mentioned, at Muntanga. Modest OPEX at about $32 a pound. Is there any optimization that you might consider to help improve the economics? You talked about...
Oh, absolutely. I mean, I've actually got a presentation next Wednesday with my my new employee, Gratis, where we've actually, his task is to go back through the whole project again with fresh eyes and work out what we could change and what we could improve, and with the link back to the exploration potential. So, if we can add pounds at Muntanga East, then we can actually bring them in earlier and increase, and that just scaling helps straight away. But there's things like, our primary crusher, we know, because they really come in one side, is at 50% capacity. So we don't have to make an investment. Even our secondary crusher is sitting at about 75% capacity. It's almost idling. And those are big capital items that go in. So yes, those can be changed. We had a clarifier in there we really don't need. It was put in to be safe, but going back through the data again, we can take that out. We've got an iron strip process as well, where we do it in 2 stages. Re-looking at it, we can do it in 1 stage. So there are aspects of that. As I said, on the mining side, we've gone back to look at the mining equipment and said, we originally scaled our mining equipment so it would handle both the big deposits and the small deposits. Now that's not the case. We can focus on the big projects. The life of the mine is long enough to use their life up. So we're re-looking at that. So there's many aspects here that we've got, but we've got the fundamentals. The design itself doesn't need to change. It's what can you do to tweak it and make it better.
And you talked about your fleet. Are you considering right now owning your equipment or contracted equipment?
Actually owning it, but we'll lease it.
Okay. So that's sort of one form of financing.
Exactly. So you don't have to buy it up front. You just lease it over the life of the fleet instead. If you go contractor, you effectively lease it and you pay a 10% margin over the top, or 20% margin or more with contractors. Yeah, contractors are great if you want to keep your capital right down, but they do cost you OPEX wise.
Yeah. Now, you did mention either expanding the life of the mine or expanding production as ways to improve economics. Is the expanded production option something that you'd have to do right out of the box? Do you need to find some pounds immediately?
Well, that's really kind of what we're looking at right now. So say if you could get pounds out of Muntanga East, we're already putting 3.5 million tons through the plant for 2.2. If you can get that up to 5 million pounds, let's call it that, you could probably put that one straight through at £1 million per annum, and then maybe Dibwe can come in as well at the back end. So that's why we're looking at both options here, which is, if you can debottleneck the plant, is there one item in that plant that's holding you back, but the rest of it could all actually hit a higher level without adding any extra capital? That's effectively what we're trying to do. So can you make it bigger, and can you get longer life out of it at the same time?
So is the key expanding existing resources, or do you think you've got to make new discoveries? I guess you talked about one that you sort of know is there, it just hasn't been drilled off yet.
Yeah, it's a combination of things there, David. So, I mean, if you looked right around the mine itself, you've got Muntanga East, you've got Dibwe, but also there's about 5 million pounds in Dibwe East itself and Muntanga, which with a few extra holes, we can bring them back into the design straight away. So, that's 2 years of production. But again, can you just increase that capacity? Kariba Valley is a different thing. I mean, it's potentially a mine in its own right. So, we then have to look at, do we do one mine, finish it, and then move everything across? And so again, modularization becomes part of the conversation for us as well. Can you mine for 10 to 12 years on the current mine, then pick up the whole plant and just move it? And most of it's actually very mobile.
Okay. What might you expect? When might you expect to get that final permit? Your ESIA.
Well, we've just filed the RAP. There's a process we now have to go through of community meetings. It normally takes 6 months. Can take a bit longer, but we'd probably get it early next year.
Okay. Okay. And then how quickly might you be able to get a final investment decision?
Well, as I say, that's going to be down to the market more than anything else. I mean, look, we did the feasibility study numbers at 90. We went out looking on the debt at $80, just to be careful because that's where contract is. But that doesn't give you a lot of flexibility. You're not leaving yourself much in the way of de-risking. So, love to see prices higher, which would then underpin that. We need the contracts as well to go there. And, at the moment, I am waiting to see what this month end coming through. There are 3 RFPs out there at the moment we filed for. But if you get another month end at $80, then, we're going to be sitting here waiting for better prices to come through. But I think they're coming. I mean, I think very much, as I said in the presentation, I mean, if you look at the fundamentals of growth going forward, if you look at the fact that utilities are really holding back on their purchasing, they really have not been as active this year as we would normally expect them to be and where the books are. They've been reducing their overall inventory to life as well, while they wait to figure out what the hell to do with tariffs, for example, being a major issue. So do expect that to come through. And so we're just saying, we're like, we might as well take this opportunity. We know where we stand in the market. Let's see what we can do to come up with a better project in the meantime.
Yeah. So what are the financing options you're really considering? You talked about debt and offtakes, and
we're basically looking at debt underpinned by offtake. I mean, that's one. Any project debt is always going to want offtake. You're just never going to get in. And the reason you do that as well is because the more you can underpin it, the better debt coverage ratio you'll get. And if you can get a lower debt coverage ratio, you actually get more debt relative to the revenue. So it does pay to contract, but obviously as well, you've then got to consider how your contract structure as well. And we have collared contracts, we've got fixed contracts, but the risk committee will always look at things with definitely a glass half empty scenario. And so therefore, if you're going to go out on a contract that has a collar, the risk committee will always look at the bottom of that curve. They're not going to give you the benefit at the top, and they won't give you the middle. They'll give you the bottom. And so you're trying to play or balance that split between underpinning. And therefore, if you want to get higher collared contracts in, you need higher prices out there as well. So that's part of it. And then, of course, there's the equity portion that's got to come through. But the equity goes in first, but you actually have to do all the other work first.
Yeah. So you think you'd be able to consider 60-70% debt for 282 million?
That's the kind of number we're looking at. I mean, certainly looking at the debt coverage ratios we're sitting at, we're probably looking at a, $60 to $70, 60-70%. I mean, that's even at $80 uranium. So we can get higher, and we can get contracts that help support that as well. As you say, you can project finance the project, but then you can lease the mining equipment as well. So there are ways of just structuring things differently, but you do need uranium price has got to be there to support it as well.
Yeah. So with uranium right now, I think the spot price is hovering around 71, 72, but the term around $80. Are the banks really focusing on that term price? Do they get it, or are they watching spot as well?
No, I mean the banks basically will look at their comment to you is, we need contracts that underpin pricing. How you as a company get your contracts is your problem, but you have to get contracts that underpin a price, and their cash flow that they're using to finance you on is based on a price assumption. As I say, so if you want a really low debt coverage ratio, which you have to work for, if you don't, then you're going to be requiring a lot more equity to do it. So you got to balance the risk.
Okay, so market-related contracts are higher risk. So yeah, okay.
Yeah.
Now, how active in the market are the nuclear utilities that are approaching you guys at the time? You're still a few years away from production here, but by then, are they concerned about when and where they're going to get their uranium?
Certainly the big companies are as well. I mean, a couple of the big boys are out there at the moment, and they're looking at contract. There's a couple of RFPs out there at the moment that are going out to 2033. So if you look at some of the bigger players, they are always putting out RFPs. They put about 4 to 6 out a year, and they're always testing the long term to see where it's going, and they're building out. Some of the smaller guys, though, are still looking at the next 3 years only. They really are not looking out to far, and I think that's where we are going to see that change coming through, is where utilities are going to start to have to figure out where after 3 years. Because if you look where the supply demand fundamentals that are out there, next couple of years people are covered, but it's really 29, 30, it just suddenly starts to open up on everybody, and people aren't really, the utilities aren't all looking to the future. They're just worrying about the short term, but the big guys are. The big guys are definitely looking at the future.
Yeah, and I imagine you want a little bit of a mix in your customer base as well, right?
Absolutely. We have excellent relationships with utilities. I mean, we talk to them all the time. I mean, you've met my uranium sales guy. He's been doing this job for over 35, 40 years. I mean, what he does is forgotten. Most people don't know. So, I mean, we pretty well get every RFP that comes through the market, and I think that's been the interesting thing. For a long time, during the second quarter, there were no RFPs. There was nothing. It was quiet in the market. No one was doing anything because nobody knew what to do. And then in about the last month, we've seen 3 or 4 come through, which we've been on.
Good to hear. So you spent a little bit of time talking about the World Bank, but there's several of these NGOs that focus on investment in Africa and developing nations. Are there any opportunities there that might help fund construction of the project?
Yeah, I mean, you've got obvious one. I mean, World Bank's a different beast in its own right, but you've got the other DFIs that are out there as well. You've got the things like the DFC. You've got EDC if you've got a lot of Canadian content into your project as well. You can also use the export credit agencies to support you from an insurance point of view. So things like ECIC out of South Africa, that brings your PRI cost down a lot. So you're cutting down your insurance fees. And the other good thing about things like the ECAs is they give you 100% political risk coverage and about 80% commercial risk coverage. So, if a bank is accredited and comes under that, they're effectively got an insurance for their loan against you, which brings their rates down. So it's very important to try and get the export credit agencies, etc., involved. Now, you can get those out of other areas as well. Europe, you can get Proparco. They've changed their name now. I can't remember what they're called now. But you can get it from the Finns, the Germans, etc. So if you can get contracts to sell uranium into Europe, you can get export credits for projects out of those. So there are different beasts here. There are also, as well, the straightforward, you've got the commercial lenders, but also you've got the funds as well. There are some fairly substantive, funds out there that lend to to build mining operations as well, just direct lending.
Okay. So you mentioned geopolitical risk. Now, Zambia is pretty organized. I'd say it's low risk for Africa, known mining center. Like you said, keen to diversify away from, not away from copper, but at least a focus on copper. Other than permitting, is there any real physical support that you can get from Zambia, or what might you like from the government?
Yeah, the government tries. I mean, it's got the Zambian Development Agency sitting there, so they kind of help you on things like people issues. If you've got to get permits in, they'll support you working with government as well. Therefore, I mean, don't forget, I've got a full 100% Zambian personnel crew out there as well, and actually, two of our directors are Zambian at a local level, and now we've got this large investment as well. But we found the government to be very pragmatic. If you need something, you just go and ask. The other one I find that's very helpful as well is in Zambia is they've got a very committed chamber of mines, which works as a body. And every time the government is looking at a law change, it will always come and talk to the chamber as well and get feedback from the chamber. It doesn't always listen, not always, but most of the time it does. But I think what's key for me, though, is not and what was key about the sort of 3 times copper thing, it wasn't like we want you to have 3 times copper. They have tried to create a scenario that supports that, increasing the amount of power, increasing the infrastructure. They've done a lot of work on border posts. Got something you wouldn't think about, but they have, because trucks were just getting stuck at borders and couldn't move through them with consumables and or copper trying to get out of the country. So they've been trying to radically improve. They're about to build an oil refinery inside as well, and they're going to pump crude oil in. So again, a way of getting fuel, because I mean they can get many more products out of the crude than they can just by bringing diesel in. So again, trying to find ways to improve the infrastructure in country. They're doing a lot.
Yeah, might that actually be good for your acid, as well?
Possibly, but there's so much acid coming out of the smelters already.
Well, that's good. That is good. So,
absolutely.
Okay, maybe on the flip side from Zambia, can you give us any update on Niger, Meduela?
Yeah, absolutely. So, look, as you know, we went to ICSID with them. We took them to court because we certainly felt they were completely unlawful in what they had done. Our discussions with them at the beginning of the year were very much, yes, it was very clear they had realized what they had done. We've therefore agreed to negotiate. I have to say, though, the negotiations are slow. And partly because I believe we are going to see political change in Niger. That's still going to come through. I mean, if anyone who watches Niger, it's very hard to watch in Niger because basically most news items are banned. But you can see a government now that is only paying its soldiers once every 2 months. The Chinese have shut down the oil refinery, so the word is they're running slowly out of diesel out there as well. Nigeria's cut a large amount of the power into the country. Most borders are closed and not going anywhere. So, in our point of view, we're negotiating. And you got to remember, David, as well, we had a license revoked from us, wrongly so. And if we're going to get a license back, we need the time to catch up for everything that we have to do again. We're going to have to redo the economics for that project. We're going to have to redo the ESIA. We're going to have to build a team. I've got one person left in the country now. And so, it's not a case of just give us the permit back. It's like, give us the permit back, but we actually need it with all of these other facets built into it so that we don't get caught again 2 years from now. We need to be able to commit to the long term on it. So I think we're sitting in a very strong position still. And, we're playing the long game. It's allowed us, though, to very much pivot to Zambia, focus on getting Zambia done. And that kind of plays back to your earlier question on, can you do multiple assets at the same time? But this has allowed us to put all our capital in one place and say, well, let's just invest on Zambia, get it going. Mm-hmm. We've got a very strong legal position there. I've spoken to a number of parties outside who nobody will go near it, that license, because they know we've got an arbitration sitting on top of it. And so it will come back, in my view. We'll wait and see. And particularly if we get the ex-president comes back into power, then I think definitely he was a strong supporter of us. But in the meantime, we'll focus on Zambia and get it moving forward.
Okay, excellent. Thank you for that. I guess to wrap things up here, you said the GoviEx is cashed up for activities this year. How long do you expect the current cash to last, and when might you need to raise again?
We normally come out for about just over a year's worth of work. So we cashed up in May. That'll be kind of when we'd come back through. And a lot will depend. If the uranium market suddenly turns on us, David, then obviously we'll become a lot more aggressive towards the development, and then be focused on accelerating that project. You got one question I see here on the questions that typed in. Is the Meduela database secure? Yes, it's not in Niger anymore. It's actually in my house. So yes, it's over here. Everything.
Right. Okay. Perfect. Well, thank you for that, Daniel. Appreciate you talking to us again today.
Thank you. Appreciate the questions, and thank you for the opportunity.
Okay, thank you for everybody else tuning in. Red Cloud Securities will be back on Monday afternoon. I'm going to sit down with Premier American Uranium and Nuclear Fuel CEOs when they put those companies together, as they put those two companies together. So that call again, Monday, July 28th at 2 p.m. Eastern. So have a great day, everyone, and thank you for supporting Red Cloud's webinar series.